The most common question I get is, what do you trade? Or what's on your watch list? Or what should I trade? They're all different ways of asking the same thing. Can I just copy what you're doing? So today I'm going to help you unlock a deeper understanding of how different markets affect each other and why looking at one chart or copying someone else will never make you profitable. I'm going to show you my actual watch list, walk you through the 4 charts I check before every trade, and help you figure out which assets respond favorably to your style in 3 easy steps. Because nailing down what works for you separates traders who gamble from traders who actually grow their accounts over time. The way you become profitable is by testing a lot. Honestly, sometimes it feels like throwing spaghetti against the wall and seeing what sticks. Some assets are going to suit your style and others won't. You don't know until you've put in the time. This is my current watch list. It's longer than most people expect, but I don't trade everything on it. I use most of it just for signal. I keep it sorted by price percentage change. So when I wake up in the morning, I can see what's moving. The biggest gainers at the top and the losers sink to the bottom, saving me a lot of time. We don't want to long something that's already pumped 10%. We want to find something that's consolidating and about to change trend. It also helps us to read if the market is in risk on or risk off mode. And having a properly sorted watch list trains your eye for this over time. We'll get into the risk asset explainer in just a bit. I also split my list into 4 sections, so related assets are grouped together. And I keep them in order of what I trade the most. I keep commodities at the top because this is where most of my profits and wins come from. Gold, silver, oil in 2 forms, natural gas, platinum, copper. I love trading these. Brent and the WTI are both crude oils, but they're priced from different regions. Brent is the international benchmark and the WTI is the US one. They mostly move together, but the WTI tends to lag Brent slightly. So if I've missed a move on Brent, I can normally catch it on the WTI. Here's the thing about commodities. Understanding what copper or oil are is easy. Trading them profitably is hard. The traders who do well in these usually specialize in 1 or 2 of them. They study the supply chain, seasonal patterns, news that matters, and reserves data. They're not jumping between oil and gold and wheat based on a CNN headline. This isn't technical analysis. This is fundamental analysis. If you're drawn to commodities, pick one, deep dive it. Watch how it's actually going to move versus how you'd expect it to move. The gap between expectation and reality is your own education. Once you click that, nobody can take that skill away from you. Next is the Bitcoin section. This isn't just where I trade Bitcoin. This is where I analyze it. Bitcoin dominance, stablecoin dominance, MicroStrategy, and the dollar index, which is honestly massively useful because everything on that list is denominated in dollars. Then there's others, which represents altcoins, and each one tells me something different about what's driving the current price movements. I'll explain how I use these in a bit. Then there's crypto that I actually trade: Solana, Hype, and a handful of other higher beta plays. TRX, Tau, Zcash. These ones I only trade if Bitcoin is moving up. They're faster and they move bigger percentages when all conditions are right. But they also move bigger against you if Bitcoin turns. This is volatility. So they're a yes or no based on what Bitcoin is doing. When the market is clearly risk on, you will see green across the altcoins and the meme coins. This even helps us decide how to play risk off assets like oil. This part of the watch list shifts over time, depending on what's running or what I'm learning about new crypto innovation. Lastly, stocks and forex. Tesla, Nvidia, Netflix, and more. The S&P 500 and a few forex pairs. The euro dollar, the dollar yen, plus the dollar rand. Because in the end, everything is a trade, even your monthly cross-border transfer. These assets are usually better to hold long-term as spot positions. I'm usually not in and out of them weekly. They're mostly here to give me context. What is the broader market doing? Where are tech stocks and the Nasdaq going? And what is the dollar telling me? The Bitcoin and commodity trades I take react to what these are doing. These 4 sections work as a map. When I wake up in the morning, I scan them from top to bottom. What are the commodities doing? What is Bitcoin telling me? What is running in crypto today? And where is the broader market? By the time I've scrolled the list, I know where I would consider taking a trade. Trading is deeply personal. No 2 traders trade the same thing in the same way. Honestly, I'm not sandbagging or gatekeeping anything. What works for me is built around my goals, my tools, and my schedule. Even the account I'm on creates a kind of bias. It pushes me towards what's easy to trade and away from what isn't. Every good trader eventually works out their own version of that. So how do you find what works for you? Step 1 is to pick a strategy. I use the one that I showed in video 2. Major support and resistance, Fibonacci levels, multiple time frames, and momentum confluence. I also add in volatility for timing. Yours can be different. What matters is consistency. Doing the same thing, the same way, every time so you can measure. Step 2 is to apply that same method over maybe 5 to 10 assets. Mix it up. Some commodities, maybe some crypto, even a stock or two. Log every single trade in a journal. We have a link to a free one in the description below. Step 3 is where it gets interesting. After about 10 or 20 trades, you look at the data. 2 or 3 assets will jump out as your highest win rate, and the rest will be okay or harder to win on. That's not random. Those assets are responding well to your setup style, so focus there. The others, you trade smaller or less, or actually just let go of them. A journal also teaches you to ask better questions. Every time a trade works or doesn't, you ask why. And the answer is often somewhere in a different chart that you weren't busy watching. For example, a Bitcoin trade went well, and when I checked why, I noticed MicroStrategy went up an hour earlier. MicroStrategy is a company that holds a lot of Bitcoin, and their stock moves almost in sync with it. IBIT is the BlackRock Bitcoin ETF, which has a similar impact on Bitcoin and the crypto trend. So now I watch them as a cross-check. That's not a beginner thing to know. I'm totally spilling some tea right now. That's the value of disciplined trade journaling. It's not just these are my best assets. It's what sets them up so the chart and the volume align. I didn't start this way. The first trade I ever took, the one I bought the MacBook with, the one I'm filming on right now, that was a meme coin trade during meme season a few years ago. I bought it on my Phantom wallet, I held it spot, and the trend just kept going. The trade paid for a brand new laptop. I had no clear trade method or a journal back then. It was just a hunch, and I held, and it worked out. Which brings me to the 4 charts I check before every trade. First is the dollar, the DXY. Almost everything I trade is priced in dollars. Gold, Bitcoin, oil, all of it. So when the dollar gains, everything else has pressure on it. And when the dollar weakens, everything else has room to breathe. That's the seesaw, and I always check it first. Second is oil and gold. They tend to move opposite to each other. So if gold is moving, oil is usually slowing down. And when oil is moving, gold tends to move in the opposite direction. If I'm planning to buy gold and oil is flying, I'll pause and I'll wait for oil to top out before I commit. Silver is basically gold's faster and more volatile body double. They move together, but silver moves harder. If gold is up 2%, silver might be up 5%. So I'll look at silver if I want amplified moves, and I'll look at gold if I want safer options. Third is for crypto traders. And this is where I want to spend a bit more time, because this is where most beginners get the timing wrong. There are 2 charts that work together. Bitcoin dominance, which shows how much of the total crypto market is in Bitcoin versus everything else. Right now, if it says 60%, then 60 cents of every dollar in crypto is in Bitcoin, and 40 cents is in altcoins and stablecoins combined. When dominance drops, then money is flowing out of Bitcoin and into altcoins like Solana. When it rises, money flows back into Bitcoin to play it safe. So, if I want to take an altcoin trade, I want dominance to be dropping. That means the money flow is in my favor. Dominance is just a fancy word for market share. Share of total crypto. Then stablecoin dominance. Stablecoins are crypto coins pegged to the dollar, so they don't really move in price. This becomes sideline cash that traders are sitting on. When stablecoin dominance is rising, this means that traders are moving out of trades and into cash. The market is telling you that it is moving risk off because the dollar is seen as safer and more stable. When stablecoin dominance is dropping, that cash is moving back into trades and risk is coming back on. So before I can take a Solana or Zcash trade, I want 4 things to line up. Bitcoin steady, Bitcoin dominance dropping or consolidating, stablecoin dominance dropping, and MicroStrategy or the IBIT ETF moving the way that I'd expect Bitcoin to. That's 4 green lights instead of 1, and it makes the trade a much higher probability setup. Fourth is the S&P 500. The S&P 500 is the big American market index, and it tracks the top 500 US companies. And here's the thing, the S&P and Bitcoin usually move together. When the broader market is in risk-on mode, crypto tends to run with it. And when stocks sell off, crypto usually follows down. So if I'm planning a crypto trade and the S&P is moving down, that's a yellow flag for me. The whole risk environment is shifting underneath. There is also the NASDAQ, which is basically a faster version of the S&P focused on tech stocks. Apple, Microsoft, Nvidia, all of that. When tech is ripping, the NASDAQ runs harder than the S&P. And when tech sells off, it falls harder too. So watching the NASDAQ tells you specifically what tech is doing, which often leads to where crypto goes next. Now, one rule that ties all of this together. All those correlations only work if the volume shows up. The cleanest setup in the world will fizzle if all the buyers and sellers aren't there. So whatever I'm trading, I check the volume bars on my chart before I take a trade. The technicals tell me where something could go, but the volume from the order books tells me if anyone is actually going to take it there. Here's something most trading content gets wrong. They tell you what to trade, but never really how to trade it. And the truth is, the same asset can be 2 completely different trades depending on your goal. This is gold on the 1-minute chart. Look how fast it moves. Every candle is 1 minute. You'll see traders working this time frame all over the internet. YouTube live streams, Twitch, Instagram reels of someone scalping this live. And the average woman scrolling through it will see it and think that she should be doing the same thing. She shouldn't. Not yet, probably never. Most of those people have been doing this for years. And they're not just trading, they're farming views and engagement. They make money 2 ways, from the trades and from the audience watching. That's a different business than what we're building here. Plenty of bro trading channels run the exact same playbook. Behind the scenes, that lifestyle is a full-time job, sitting behind your screen for hours and your nervous system on high alert. As a mom, your nervous system is already carrying a lot. This is the last thing you want to pile on top of it. And at the extreme opposite end of this, same asset, gold, right, on the weekly chart. And over the past 2 years, it's gone almost vertical. A lot of that move came from China. Property prices crashed there, and savings that used to be in real estate moved into gold. Physical gold, jewelry, they just started stacking. These aren't people trading in and out daily. They're looking at weekly charts and building positions over months. And here's the important part. They're not using leverage or perps. They're buying spot, and they actually own what they hold. Same chart, 2 completely different jobs, right? If your goal is pin money for this week, a facial, a gift for your husband, a new pair of shoes, you're on a shorter time frame. You're looking at the 1 hour or the 4 hour, with setups that resolve over days. That's how I trade. If your goal is long-term wealth, money for the kids, retirement, generational stuff, then you're trading on the weekly or the daily. You're not trading every day. You're positioning and stacking. And just like the China story, you're not using leverage either. You're buying spot commodities or stocks or index funds for the long haul. Some people even buy dividend stocks where they get paid quarterly just for holding it. That's a completely different game from what we're doing day to day. Most beginners actually pick a time frame by accident. They open whatever default the platform gives them and just start trading. Then they wonder why their trades aren't working. And it's because their time frame doesn't actually match what they're trying to achieve. The Moms Who Trade method I teach is built specifically for that pin money time frame, 1 hour to 4 hour charts. Slow enough to fit into a mom's day, fast enough to hit your weekly goals. Here's what this actually looks like in a week. Monday morning, before I jump into any trades, I sit down for 20 minutes and do a check. The order matters. First, I look at the DXY. Then I look at Bitcoin and Bitcoin dominance, and then I move into Brent crude. By the time I've done those 3 or 4 checks, I know what the dollar's doing, I know what crypto is doing, and I know what oil's doing. That's the macro picture for my week. Then I spend the rest of my time going through my watch list properly, looking for assets that are consolidating, assets that are changing trend, and assets where I can see a setup forming. I write down the key levels, where I want to buy, where I want to sell. I'm not predicting anything. I'm just preparing. Then, during the week, when I sit down for my hour of trading, I already have a plan. I'm checking against what I wrote on Monday and waiting for a trigger. That's how trading actually fits into a mom's life. Here's your homework for the week. Go and open TradingView. And if you don't have it set up yet, go and watch my first video. It walks you through everything step by step. And if you haven't placed your first paper trade, video 2 has you covered. Once you're set up, add 5 things to your watch list this week. The DXY, Bitcoin, oil, gold, and silver. Bitcoin is on this list because it is increasingly being treated as digital gold. Same inflation hedge thesis. A lot of people are holding Bitcoin in the same way they'd hold gold, long term and not actively trading it. So watch how it moves alongside gold and against the dollar. You'll learn a lot by just watching these relationships. Watch them every day this week and just notice the patterns. Then over the next few weeks, start testing. Apply the method from video 2 across these assets. Add a couple of cryptos if you want, but log every trade and build the data. After about 30 or 40 trades, you'll start seeing where your win rate actually lives. And that becomes your focus from then on. Once you've narrowed that down, that's where video 3 comes into play. It's about pin money and how I use this every week, not just to trade, but to trade for something specific. A facial, a trip, anything you want. Most trading content tells you what's exciting. I am telling you to find what fits in your life. Find your method, find your asset through a journal, and match your time frame to a goal. That's how this actually works.